Have you ever wondered why some countries, despite decades of economic growth, still seem trapped in cycles of borrowing and austerity? But the reality is far more complicated and, for many nations, quietly punishing. Imagine you were a policy analyst in Berlin, or an accountant in Chicago, or a young economist in Madrid. You follow the news closely, tracking global markets, and you notice headlines like Country X signs, IMF bailout package, or IMF approves $5 billion loan. At first glance, these loans seem like relief, lifelines extended to countries in need. They promise stability, confidence from investors, and a path to growth. You earn $4,500 per month after tax. Your rent is $1,500. Car payment $400. Insurance $300. Utilities $250. That leaves $850 for savings or unexpected expenses. On paper, you're managing. But then, suddenly, your income drops by $1,000. Suddenly, debt looms, stress builds, and your options shrink. This is the same dynamic that the IMF imposes on nations. Countries borrow to stabilize their economies. The IMF provides cash, yes, but with conditions. These conditions often force governments to cut spending, raise taxes, privatize key services, and tighten monetary policy. But the effect on ordinary citizens is starkly similar to that sudden personal income drop. Social programs shrink. Public sector jobs vanish. Healthcare and education budgets tighten. Imagine a country with a GDP of $200 billion and debt of $150 billion. It needs $5 billion to cover immediate obligations. The IMF agrees to lend the $5 billion, but the repayment terms include high interest and strict austerity conditions. Over the next 5 years, the country must prioritize debt repayment above most other expenditures. Schools may remain underfunded. Infrastructure projects may be postponed. Citizens face a slowdown in economic opportunities. Meanwhile, the government is legally bound to make these payments regardless of social consequences. Psychologically, countries, like individuals, often accept these loans because the immediate relief feels like safety. The alternative, default or bankruptcy, appears catastrophic. Leaders, wanting to avoid crisis, sign the agreement. Citizens may not fully understand the trade-offs. Debt feels like a solution, even though it imposes long-term restrictions. Each loan may temporarily stabilize the economy, but it also increases future obligations. Governments are caught in cycles: borrow, implement austerity, repay, and then borrow again. Citizens experience recurring economic pressure, rising unemployment, and slower social progress. Macroeconomic indicators may appear stable. In practice, households feel squeezed, and inequality can grow. Financially intelligent thinking at the national level. Some countries build structures that reduce dependency on external bailouts. They maintain prudent fiscal policies, diversify revenue streams, strengthen domestic industries, and cultivate foreign reserves. They plan for volatility and build buffers before crises occur. When downturns arrive, they adjust gradually without extreme austerity. Their approach is not fear-based. It is proactive, strategic, and focused on long-term stability rather than short-term relief. The subtle flaw in IMF loans is that they externalize risk. The money comes immediately, but the cost is deferred. The social and economic burden is shifted onto citizens, who face higher taxes, reduced services, or slower wage growth. Leaders may hope for quick growth to offset the debt, but volatility rarely unfolds neatly. The loan provides immediate relief, but at the cost of long-term flexibility and autonomy. It solves one problem while creating another. In practice, financially intelligent nations treat debt as a tool, not a crutch. They borrow only when necessary, and only with structures that limit social disruption. They diversify economic activity, so shocks in one sector do not force extreme austerity. But without careful planning, they introduce structural pressure that can limit flexibility and burden ordinary citizens. The problem is not always visible in headline numbers or macroeconomic indicators. The relief provided today may create constraints tomorrow. Imagine a country that agreed to a $5 billion IMF loan with strict conditions. Citizens breathe a little easier. Headlines celebrate stability. Consumer demand slows. Businesses that depend on public contracts see revenue decline. Households Feeling the pinch, cut spending. The loan repayments, combined with interest, now consume a significant portion of government revenue. The short-term solution has become a long-term structural constraint. Psychologically, governments and citizens adapt to austerity. Leaders may hope for quick growth to restore flexibility, but they are constrained by the binding obligations of the loan. Citizens normalize lower consumption, fewer services, and slower wage growth. Over time, the perceived stability of the IMF loan fades, and the true cost becomes visible: reduced freedom, slower economic mobility, and heightened risk of social unrest. The cycle often repeats. Countries may take another IMF loan to cover the next shortfall. The immediate problem is solved, but the country's economic independence erodes. Now, contrast this with financially intelligent national strategy. A country anticipating volatility builds buffers before a crisis. They maintain foreign reserves, diversify exports, develop domestic industries, and create contingency fiscal policies. When a shock occurs, they can respond without imposing extreme austerity. Social services remain intact, and citizens experience less disruption. The country retains the freedom to make choices. Optionality is preserved. For instance, consider two countries with similar GDP and debt levels. Country A relies heavily on external loans whenever liquidity issues arise. Country B maintains a portion of its reserves and uses conservative fiscal policy. When a downturn occurs, Country A must impose deep cuts and raise taxes sharply. Country B can adjust moderately, maintaining services and economic momentum. The difference is not luck, it is structure and preparation. Another subtle factor is debt composition. Not all debt is equal. Low-interest, long-term bonds allow flexibility. Short-term, high-interest loans increase vulnerability. Countries with carefully structured debt can withstand temporary shocks. Countries relying on high-interest IMF loans face more rigid obligations. They trade immediate relief for reduced strategic freedom. Leaders often focus on the visible benefits of IMF loans, headlines, market confidence, and short-term stability. This mirrors personal finance. People often overvalue immediate cash relief and undervalue long-term structural freedom. The long-term impact on citizens can be profound. Ordinary people experience slower wage growth, higher taxes, reduced social services, and limited job opportunities. Household stability becomes contingent on global financial flows rather than domestic productivity. Financially intelligent national strategy, by contrast, treats borrowing as a tool, not a crutch. Reserves, domestic revenue sources, and policy buffers absorb shocks, reducing dependency. Growth initiatives continue even during stress periods. Citizens experience more consistent economic opportunity. Suppose an IMF loan costs a country $500 million per year in interest and repayment obligations. If the same country had built reserves of $500 million over time, it could weather the crisis without borrowing. The savings would allow moderate fiscal adjustments instead of deep austerity.